Welcome to the Deep Dive. Today we're looking at the auto industry in 2025. It's facing just a whirlwind of changes, isn't it?
It really is. You've got tariffs, the whole EV transition, competition from China. It's a lot.
Definitely. So we've gathered insights from PwC on auto trends, a White House fact sheet on production incentives, the UAW on tariffs, AIAD on international automakers, and CIR on tariff impacts. Quite a mix.
Yeah, a good range of perspectives. And our goal today really is to cut through some of that noise. We want to understand the big challenges, the opportunities, particularly around these potential tariffs and the EV shift.
Right. So where should we start? Tariffs seem like the immediate hot topic.
Let's dive in there. So PwC has laid out what these proposed tariffs from President-elect Trump could mean.
And it sounds pretty significant. They're talking, what, 10, 25% on Canada and Mexico?
Yeah, and then up to 60% on China.
Yeah.
But the really eye-watering ones are the potential 100, 200% on vehicles made in Mexico.
Wow, 200%. That would really shake things up for consumers, wouldn't it? PwC mentions higher prices.
Absolutely. Higher prices are a major concern. And, disruption to the supply chain. The U.S. auto industry is so integrated, especially with Mexico.
And that idea of a broad 25% tariff on all goods from Mexico, that just adds another layer of uncertainty.
It really does. It amplifies all those potential impacts.
Okay, but then you have the UAW. Their perspective is quite different.
Very different. Yeah, they're actually applauding the idea of tariffs on imported cars and trucks.
I saw their president called it the beginning of the end of NAFTA and the free trade disaster. That's strong language.
It is. They see this as a chance to, bring back union auto jobs, stop what they call the race to the bottom on wages.
So for them, it's about incentivizing production here in the U.S.
Exactly. They believe tariffs are the way to do it.
Yeah.
And they're pushing automakers, saying you should absorb these costs. Don't pass them to the consumer.
And they want the USMCA renegotiated, too.
That's right. The U.S.-Mexico-Canada agreement. They want another look at that deal.
So it's a real clash of views. Potential price hikes versus hope for more domestic jobs.
Definitely. But there's another piece here, the international automakers. AIEA, the group representing their dealers, brings up some important points.
Right. They mentioned that these international brands account for, over half of vehicle sales? And dealership jobs, too.
Yeah, 57% of sales, over 50% of dealership employment. And crucially, many of these international companies build cars right here in the U.S.
Oh, yeah, good point. AIATA lists examples, like Honda CR-Vs in Indiana and Ohio.
Exactly. And the Toyota Tundra in Texas, BMW X5 in South Carolina, Nissan Altima in Mississippi, the Mercedes Sprinter also in South Carolina.
So tariffs aimed at, quote, imports could actually hit vehicles built by American workers in American plants.
Precisely. It complicates that domestic versus import narrative quite a bit.
And the Center for Automotive Research, CIR, they've crunched some numbers on this.
They have. Their analysis looked at a hypothetical 25% tariff on all imported auto parts and finished vehicles.
And the potential cost.
It's pretty staggering. They estimate it could cost the entire U.S. auto industry about $107.7 billion, affecting maybe 17.7 million vehicles.
$107 billion. And for the Detroit 3 specifically?
For them, CIR estimated a potential cost of $41.7 billion, impacting around 6.8 million units.
And their key finding was that basically no vehicle would be untouched, right? Because none are 100% U.S. made.
That's the crucial takeaway. Every vehicle has some imported content. So this cost increase, it wouldn't just hit the automakers. CR suggests it would ripple through the whole system.
Meaning ultimately higher prices for you, the buyer.
Most likely, yes. It gets distributed to automakers, suppliers, dealers, and probably consumers, too.
But wait, there's been a development, hasn't there? Something about the Trump administration actually relaxing some tariffs.
Yes, that's a recent twist. Based on a White House fact sheet and reports, it seems President Trump plans to sign executive orders offering rebates on those 25% tariffs.
Rebates? How does that work?
It sounds like a 15% rebate this year, then 10% the second year. But specifically for automakers who finish their vehicles domestically.
Ah, so it's an incentive to do the final assembly here.
Kind of. The administration is framing it as a short-term transition. The idea is to encourage companies to move parts production back to the U.S. eventually, bring jobs back quickly.
Sort of a carrot alongside the stick? A temporary softening?
Seems like it. But, not everyone is convinced this solves the bigger issues.
Right. Telemetry, the advisory firm, had a forecast, cited in the Economic Times.
Yeah, they looked at the impact of a prolonged trade war, even with these current tariffs. Their prediction is pretty concerning.
What did they find?
They think it could cut U.S. and Canadian auto sales by maybe 1.8 million vehicles just this year.
1.8 million, wow. And longer term.
If these tariffs stick around until 2035, telemetry suggests sales could drop by a cumulative 7 million units compared to a no-tariff world.
7 million fewer cars sold. That implies higher prices, maybe layoffs too.
That's the worry. Higher prices for you, potential job losses in the industry. Even if some production does shift back, it's complex.
Okay, so that's the tariff minefield. Let's shift gears a bit. The other huge force is sustainability, the move to EVs.
Absolutely. And PwC points out something interesting here. Even if, say, a Trump administration rolls back some federal policies, Biden-era emissions rules, maybe parts of the Inflation Reduction Act,
Which has big EV incentives.
right, even if that happens federally, it's not the whole story. You still got state regulations like California's and international standards.
So OEMs, the manufacturers, might stick to their green goals anyway?
PwC suggests many will. It's not just about rules. There's consumer demand, global market pressures. So companies are advised to sort of keep planning for carbon reduction in EVs, even with policy uncertainty. Use scenario planning.
That makes sense. But PwC also flags an issue with the EV transition itself, right? Consumer adoption.
Yeah, they note that despite massive investments by automakers and suppliers, consumers haven't adopted EVs quite as fast as everyone hoped or projected.
And that's hitting the bottom line.
It seems so, impacting profitability, cash flow, even hitting those regulatory targets we just mentioned. It's a real challenge right now.
So what's the advice there? How do automakers navigate that?
Well, PwC suggests focusing on making current operations super efficient, generating cash, maybe regionalizing supply chains more, perhaps selling off non-core assets.
And making EVs more attractive.
Definitely. Better pricing is key, more advanced tech, and of course, sorting out the charging infrastructure issue. That's still a big hurdle for many people.
And speaking of EVs, the AIA report had some interesting stats on who is selling green vehicles.
Oh, right. They showed international brands have a really significant market share in green vehicle sales in quite a few states.
Yeah, like Alaska, 67% share in 2023. California was 53%. North Carolina, 67% again. Utah, 59%.
It really highlights that the EV market isn't just dominated by, say, Tesla or the Detroit companies. These international players are major contributors.
It shows the breadth of the market, definitely. Okay, so we've got tariffs, we've got the EV transition. What about competition, especially from China?
That's the next big pressure point PwC identifies. Traditional OEMs are facing really intense competition from Chinese manufacturers.
And they've come a long way, particularly in EVs.
Huge strides. PwC notes significant advancements in their EV engineering, design, development, manufacturing over the last 15 years.
And the kicker is the cost, right?
Exactly. Their EVs are often significantly cheaper. PwC says potentially over 25% lower in cost. It's a massive advantage.
25%. How are they managing that? Is it just labor?
It's more than that. They've built very efficient, often vertically integrated supply chains specifically for EVs that gives them big advantages on battery costs and other components that traditional players are still trying to match.
So what do traditional automakers do? How do they compete?
Well, PwC advises heavy investment in tech and innovation, trying to keep pace, especially on EVs and related infrastructure, and finding ways to cut production costs without hurting quality. That's crucial for competitive pricing.
And they still need their traditional gas-powered cars to make money, right? To fund the EV shift.
That's a key point PwC makes. Maintain profitability on the ICE side to finance the very expensive transition to electric. It's a balancing act.
And it's not just the cars themselves, it's the software too. This idea of the software-defined vehicle, or SDV.
Right. The shift towards cars that are constantly upgradable through software, like your phone. Functionality is increasingly software-driven.
And traditional OEMs are lagging there.
Often, yes. PwC suggests they're behind many Chinese firms and newer tech-focused OEMs. Part of the challenge is their complex existing portfolios.
Yeah.
Lots of different models, different platforms.
Makes it harder to implement a unified software approach across the board.
Exactly. It's time-consuming, capital-intensive. So PwC says they need to really adapt their product development, their business models, develop a clear SDV architecture, streamline software work, reallocate capital strategically. It's a big internal shift.
So, wrapping this all together, PwC offers some strategic advice, almost like pitfalls to avoid for leaders.
Yeah, some key takeaways. One is, don't just keep allocating capital the old way while also trying to fund all this new tech. You need to prioritize, maybe find partners.
Focus is key. And don't just chase competitors.
Right. Have your own clear vision. Play to your strengths. Don't make big bets that lock you in and reduce flexibility for later because things are changing so fast.
Keep that flexibility and make sure the core business is generating the cash needed for this transformation.
Absolutely. And generally, leaders need that strategic focus, smart resource allocation, keep introducing new EV capabilities, new business models, while also managing all these economic headwinds like tariffs.
Okay, so let's try to recap this deep dive. It really feels like the auto industry is navigating a perfect storm right now.
I think that's fair. You got the whole tariff situation, the uncertainty, the potential costs and sales impacts, even with these recent rebate ideas.
Which, as RR noted, might have benefits concentrated in some areas, but pain, like higher costs, felt more broadly by you, the consumer.
Right. Then there's the EV transition, essential for the future, but adoption is maybe slower than planned, creating profitability challenges.
And layered on top is this intense global competition, particularly from China, pushing hard on cost and innovation, especially in EVs and software.
It's a convergence of major forces all hitting at once.
It really makes you wonder, and this is maybe a final thought for you listening, how does this change what it means to be a successful car company?
That's a great question.
Like, are the old metrics just selling the most cars, having the biggest market share? Are those still the main goals? Or does success start to look different?
Maybe things like adaptability,
Yeah.
technological leadership, how sustainable your practices are. Could those become the new benchmarks?
Yeah, will we measure success differently in the next decade? It's definitely something to mull over as this industry keeps transforming at such a rapid pace. Thanks for joining us for this deep dive.